All right, David Moore, Equity Advantage with Robert Smith of Peregrine Private Capital, and we are mid-June of 2023. And I got up sort of cranky this morning, but you made me happy. You know, I think part of it is that nice pinstripe suit, and you start talking about nicknames. And
be careful.
Be careful. I'll bring up once I had a buddy, so I posted a picture. We just had Father's Day last weekend too, and I'm blessed because one of my daughters graduated. I had a great weekend. Graduated from college finally, so my last one, all three are done. Got their diplomas.
Pay raise.
So the pay raise, exactly. So I had this picture that I posted of my dad and then a good buddy of mine, Mike Jones, and his father. At the center court and tennis court, and the dads had lost. We'd had this perpetual trophy made every time Mike and I played our dads. We'd put the big trophy center court and play for it, and whoever won it, we'd put a little Dymo tape on there as the victor for the day. But the two dads were there holding the net down, complaining that the reason they lost that day was the net was too low. It's never a legit win. But Mike's dad, who was probably 5'8", we named him Too Tall Jones. So that was I thought that was a great
Ed Jones, Too Tall Jones.
Yes, okay. Exactly. So you and I know the real Too Tall, but anyway, so we're talking about nicknames, longevity, things. You're talking about you and what you used to do for a living, or living in college, I guess I should say, running. I mean, this guy, we've never really talked about history, but this guy actually ran at Oregon long distances with some very famous people and did very well. So that's a part of your history that people out there probably do not know, but now you do a little bit. So we're talking about winning at distance, but I think what we're looking at is an economy right now that you better be looking sort of at a longer term, and we want to talk a little bit about what you perceive to be happening, we perceive to be happening, and we are sitting in the same room we always do. We've pointed out in the past that behind us is lots of empty office space. So what do you think is going to happen with the banking environment, of lending, and sort of what kind of advice? And like I said, I was the sprinter, he's the distance guy. So with hard work, you can get to that finish line and make things happen with a little bit of education and knowledge.
Yeah, I think you will qualify that with the only reason someone runs long is because they can't run fast, David. So, had to reach out. We've talked about shadow tenancy in office buildings before, as David's mentioned. You know, you look over his shoulder and you got 4 floors of empty office building, and this is something that most retail investors aren't aware of. Retail investors meaning folks like you and me, as opposed to institutional investors, because it's not something that impacts them directly, but what we would like to call the doom loop, if you will, that's developing in the office market and to a lesser extent in retail. And we've got something like approaching $1 trillion worth of leases that are expiring in the next 2 years in the office and retail sector, at a time when interest rates are much, much higher and vacancies are much, much lower. And you have heretofore, going through COVID, you had shadow tenancy, meaning you had tenants who were no longer occupying properties but continued to pay rent on those leases. Well, those leases are set to expire, and when those leases expire, with remote work being an accepted part of American culture, and with the labor market still tight and employers having very little leverage to force people back to the office, we think office properties are becoming obsolete. Or, we'll talk about obsolescent property types. There's way more office than there is need for it going forward. And so you're going to see lots of these properties go back to the lender at the institutional level, meaning that they can't be released, they can't be refinanced, so the landlord just gives the keys back to the bank, and the banks may be saddled with very, very significant losses in the office sector going forward. Conservative estimates put downward valuations on office buildings at as much as 50% now. I think we mentioned earlier the Union Bank building in San Francisco that just recently went on market, which sits on California Street, middle of the financial district. San Francisco and New York pre-COVID had some of the most expensive office real estate on planet Earth. This property was appraised at, I think, $300 million in 2019. They're now getting bids of $50 and $60 million on it. That's an 85% valuation loss in about 4 years. And that is something that retail investors need to understand. It's not unlike what happened when the housing market collapsed in 2007, 2008, albeit that impacted us directly, so we were very much aware of it. But all these lenders were saddled with bad loans, lost lots and lots of money as a result of that. So to hedge against those losses, they had to raise capital, and in so doing, they pulled in their horns from a lending standpoint, and credit became much, much tighter. We think the same thing may very well happen, albeit at the institutional level. Big lenders facing big losses on these office buildings will likely pull in their horns from a lending standpoint to raise their capital levels against these anticipated losses, making the lending environment even tighter than it already is, and perhaps making credit even more expensive than it already is. And whether you like it or not, even though that's at least one step removed from retail investors, it will impact retail investors in terms of their ability to access credit for properties in 1031 exchange or just straightforward real estate transactions. So it's probably going to have a ripple out effect, and it may take an already very cold lending environment and turn it into a new ice age, make it much, much more difficult to obtain credit to buy property. So that's something everyone who's anticipating selling property, being in a 1031, needs to anticipate.
Well, I mean, if we're looking at commercial buildings, I mean, I think that the real issue I'm concerned about is not just the credit for purchase and sales, transactional stuff, but it's just to actually maintain assets. Right. You're unlike the residential world where you can go put a 10, 20, 30, 40-year mortgage on something and just pay it off. I mean, the commercial world doesn't work that way, right? So you've got time, money, you've got now assets that, and I think your comment on shadow tenancy is very, very important, because a lot of people might not understand and say, well, okay, the published occupancy rate of this building might be this. Well, it's really down here, right, with all those people, like you said, paying through their term, and as soon as that term's expired, they're out. Meanwhile, the assets still have to somehow qualify to be refied. And if you look at those transactions, most of those buildings are probably using cost seg too. So, I mean, you think about basis and gain on things. You think about what happened the last crash. I'll tell you what happened the last crash. We had something called phantom gain that we dealt with a lot. And we did a lot of transactions with you into DST assets and those zero coupon offerings, right? And so one of the big fallacies in 1031 is you have to replace debt in an exchange. But we had people losing properties through foreclosure. And in that situation, you say, well, how can I have a gain when I just lost a property foreclosure or short sale? And people don't understand, well, the gain is nothing to do with profit. Gain's simply a tax calculation. And gain is triggered when the difference between the basis and the adjusted sales price. Well, in a foreclosure or short sale, the debt's the sales price. And therefore, if the debt exceeds the basis, you've got what's called phantom gain. You can lose the asset and pay tax for the pleasure of doing so. So it's really important for people to understand, I think, that issue and really be aware of what's going on. But these buildings, I mean, it is going to be interesting to see who comes back. I know we've got lots of companies now saying, hey, I want the employees back. Right. Even the state of Oregon actually saying, hey, we want them back in the office working. But it's one of those things where people need to be aware of what is out there, and that market velocity. People think that banking and financial world just going to impact those purchases. No, it's going to definitely be impacting. In a recessionary time, as I say, typically you're going to have a reduction in loan to value on a loan, and you're going to have a situation where you probably have a reduced value of the building, which therefore reduces your equity in the building, and inevitably you're going to have a capital call. So I think it's really something that people need to be aware of and plan ahead for. And if you've read our old recession investing newsletter page, it just talks about, hey, the person that the recession comes, I'm just gonna move to Hawaii and sit it out. But people that really have the ability to make hay during those times, they're going to look at any change, brings opportunity. Mm. So it's how are you going to get through this? But I think the best weapon against a problem is obviously knowledge. And if we just look historically what's happened, what do they say about history and repeating itself?
Yeah.
Those who don't study it are condemned to relive it. So this is actually the end of our kickoff segment today, and we'll be right back. Don't go away. David Moore, Equity Advantage. Robert Smith, Peregrine Private Capital. Thank you.